March 18th, 2025. The Royal Canadian Mint implements allocation systems for authorized dealers. After 37 years of continuous production and on-demand availability, Canada's sovereign mint tells dealers, you can't order what you want anymore, you get what we allow. This isn't a shipping delay, this isn't a temporary bottleneck, this is rationing, and it's happening at the second largest silver coin producer in the world. Within weeks, Perth Mint extends delivery times to 16 weeks, 4 months for a product that used to ship in 3 days. Then May 2025, the United States Mint suspends American Silver Eagle production entirely. Supply chain disruptions, they say. But let's be clear about what that means. The world's largest sovereign mint cannot source enough silver to produce coins. Now, January 2026, we're living in the aftermath. Premiums on silver maples have spiked from $3 over spot to $12 over spot. Dealers report allocation cuts of 70% from pre-2025 levels, and the physical silver market is operating under a rationing regime that would have been unthinkable just 2 years ago. This is the story of how the physical silver market broke. Not a prediction of what might happen, but documentation of what already happened. The mechanisms that failed, the timeline of collapse, and what it means when sovereign mints that have operated for decades suddenly can't get metal. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available data from mints, dealers, and market reports. Let's examine what happened to the physical silver market in 2025. The Royal Canadian Mint, 37 years of precedent. The silver maple leaf launched in 1988. For 37 years, it operated on a simple model. Dealers order, mint produces, product ships. Demand fluctuates, but supply always met it. Whether dealers ordered 10,000 coins or 100,000, the mint delivered. That model depended on 3 assumptions. First, primary silver refiners could source raw material. Second, the mint could purchase refined blanks at spot price plus reasonable premiums. Third, production capacity could scale to match demand. All 3 assumptions failed in 2025. According to Royal Canadian Mint's annual production data, silver maple output hit 30.5 million ounces in 2024, roughly in line with 2023's 29.8 million. But dealer orders for 2025 projected demand at 38 million ounces, a 25% increase driven by both investment demand and industrial offtake. The mint couldn't scale, not because they lacked machinery or personnel, but because they couldn't source blanks. Refiners who supplied the mint reported waiting 8 to 12 weeks for delivery of refined material, up from the historical norm of 2 weeks. In March 2025, the mint implemented allocation. Dealers who ordered 50,000 maples received 15,000. Orders of 100,000 filled at 30,000. The allocation percentage varied month to month, but averaged around 35% of requested volume through the rest of 2025. By January 2026, industry sources report allocations have tightened further to approximately 20 to 25% of requested volumes. A dealer ordering 40,000 coins receives 8,000 to 10,000, and delivery times, even for allocated amounts, stretch to 10 to 14 weeks. This is rationing. When you can't buy what you want at any price, when supply is distributed by bureaucratic allocation rather than market clearing, that's a broken market. The 3-layer supply chain. To understand why this happened, you need to understand the silver supply chain. It's 3 layers, and all 3 failed simultaneously in 2025. Layer 1, primary material sourcing. Silver comes from 3 sources: primary silver mines, byproduct from base metal mining, and recycling. According to the Silver Institute's 2024 World Silver Survey, total mine production was approximately 830 million ounces, with roughly 200 million from primary silver mines and 630 million as byproduct from zinc, lead, and copper mining. Primary silver mines faced declining ore grades. Fresnillo, the world's largest primary producer, reported average grades fell from 285 grams per ton in 2020 to 241 grams per ton in 2024. That's a 15% decline in just 4 years. Lower grades mean more ore must be processed to extract the same amount of silver, increasing energy costs and reducing output. Pan American Silver delayed expansion projects, citing permitting challenges and capital costs. Hecla Mining reported similar constraints. Across the primary silver sector, production was flat to declining, despite silver prices rising from 23 per ounce in early 2024 to 32 by late 2024. Byproduct silver is dictated by base metal mining economics. Copper prices were choppy through 2024 and early 2025. Zinc prices remained depressed. When base metal prices don't justify new mine development, the silver that would have come with those projects never materializes. Recycling contributed approximately 180 million ounces in 2024, according to industry estimates, but industrial recycling rates remain low. Electronics contain only trace amounts of silver, making recovery uneconomical at current prices. Solar panels lock silver away for 25-30 years, and even end-of-life recycling is expensive relative to recovered value. The result? Primary supply wasn't growing. In 2024, total mine supply was estimated at 830 million ounces. Investment and industrial demand combined exceeded 1.2 billion ounces. That's a structural deficit of 370 million ounces, filled by above-ground stocks and existing inventories. Layer 2, refining and blank production. Refiners convert raw material into 99999 fine silver blanks suitable for minting. This process used to take 2 to 3 weeks from order to delivery. By mid-2024, delivery times extended to 6 weeks. By late 2024, 8 to 12 weeks. By early 2025, some refiners stopped taking new orders entirely. Why? Because refiners were competing for scarce feedstock. Heraeus, Metalor, Valcambi, the major Swiss refiners, reportedly began offering premiums above spot price to secure material. Not spot plus 50 cents, spot plus $2, $3, even $4 per ounce, just to guarantee supply. Those premiums get passed to mints, who pass them to dealers, who pass them to consumers. The premium expansion that began in 2024 accelerated through 2025. Mints also faced competition for blanks. Private mints like Sunshine Minting in Ohio, Precious Metals, supply both sovereign mints and private producers. When demand surged in 2024-2025, private buyers willing to pay higher premiums secured supply. Sovereign mints, bound by government procurement processes and budget constraints, often couldn't compete. The Royal Canadian Mint, US Mint, and Perth Mint all purchased blanks on contract terms negotiated months in advance. When spot premiums spiked suddenly, contract prices didn't reflect market reality. Suppliers either broke contracts, delayed deliveries, or prioritized higher-paying customers. Layer 3, mint production and dealer inventory. Even when mint secured blanks, production couldn't keep pace with demand. The U.S. Mint suspension in May 2025 created immediate shockwaves. American silver eagles are the most recognized and liquid silver coined globally. When eagles disappeared from the market, demand redirected to maples and other sovereign coins. Canadian mint allocations tightened as they absorbed demand previously filled by U.S. mint production. Perth Mint, already facing strong domestic and Asian demand, saw North American dealers placing massive orders. By summer 2025, the global sovereign mint system was operating at capacity but couldn't meet demand. Dealers who historically carried 60-90 days of inventory dropped to 10 to 15 days. Some products moved to pre-sale only, with 8 to 12-week delivery estimates. Premium spreads told the story. In early 2024, silver maples traded at approximately $2.50 to $3.50 over spot. By late 2024, $6 to $8 over. By January 2026, $11 to $13 over spot for standard years, and 15 plus for certain date ranges or low mintage varieties. These aren't normal markups. These are scarcity premiums, reflecting a market where demand consistently exceeds available supply. The data. Behind the breakdown, let's look at specific numbers. According to U.S. Mint production data, American Silver Eagle sales in 2024 totaled 42.1 million ounces, the highest annual total since 2015. Then, in May 2025, production stopped. From May through December 2025, 0 new Eagles entered the market. That's 42 million ounces of annual demand that had to redirect somewhere. Canadian maples absorbed some. Perth Mint products absorbed some. But total sovereign mint production couldn't replace the missing U.S. supply. Royal Canadian Mint 2024 production, approximately 30.5 million ounces. Projected 2025 production based on allocations, estimated 25-28 million ounces. That's lower than 2024, despite surging demand. Perth Mint 2024 sales, approximately 22 million ounces based on reported figures. 2025 production, likely similar or slightly higher, but insufficient to fill the gap left by U.S. Mint suspension. Combined, these three sovereign mints produced roughly 95 million ounces of retail investment silver in 2024. In 2025, with U.S. Mint offline for 8 months, total sovereign production likely fell to 75-80 million ounces. Meanwhile, investment demand was surging. According to metals industry analysts, global investment demand for silver in 2025 was estimated at 280-300 million ounces, up from approximately 240 million in 2024. The gap between demand and sovereign mint supply widened dramatically. Private mints tried to fill it, but they faced the same blank sourcing problems as sovereign mints. Why sovereign mints couldn't compete? Here's the part that reveals the structural problem. Sovereign mints have advantages: government backing, established distribution networks, trusted brands. But they have one critical disadvantage: they can't pay unlimited premiums. The U.S. Mint operates under congressional budget and procurement rules. They can't simply pay 5 over spot to secure blanks when their budget assumes spot +1. Contracts must be approved, suppliers must be vetted, price increases must be justified through bureaucratic processes. Private buyers don't have those constraints. If a private mint or industrial user needs silver and is willing to pay spot plus $4, they get it. The sovereign mint bound by procurement rules gets bypassed. This is why the US Mint suspended production. Not because silver doesn't exist, but because they couldn't source it at prices their procurement system allowed. The Royal Canadian Mint faced similar issues. While they maintained production, they did so through rationing. Rather than pay market clearing premiums for unlimited blanks, they allocated available supply among dealers. Perth Mint operates with more commercial flexibility, but still faced capacity constraints. Demand from Asia, particularly China and India, surged through 2024-2025. Silver imports to India hit record levels. Chinese demand for physical silver increased as investors sought alternatives to real estate and equity markets. Perth prioritized existing dealer relationships and regional demand, but couldn't fulfill all orders. Delivery times extended because production schedules were booked months in advance. The industrial demand factor, one critical element that's often overlooked. Industrial silver demand is non-discretionary and price insensitive within reasonable ranges. Solar panel production requires silver paste for conductivity. Manufacturers can't substitute easily. When silver was $20 per ounce, they used it. When silver hit $32 per ounce, they still used it because there's no viable alternative at scale. According to the Silver Institute, industrial demand in 2024 was approximately 680 million ounces. Estimates for 2025 suggest 720 million ounces. Solar alone accounts for roughly 150 million ounces annually. Electric vehicles use substantially more silver than internal combustion vehicles. EV production increased by approximately 35% year over year in 2024. Each EV uses about 25-50 grams of silver in various electrical components. With global EV production approaching 14 million units in 2024, that's roughly 15-20 million ounces of silver demand from EVs alone. 5G infrastructure, electronics manufacturing, medical applications, all consuming silver at increasing rates. This demand doesn't stop when investment demand surges. Industrial buyers have long-term contracts, established relationships with refiners, and operational necessities that require consistent supply. When industrial users and investment buyers compete for the same refined silver, industrial users often win because they pay reliably and consistently. A solar panel manufacturer contracting for 5 million ounces annually provides revenue certainty that a sovereign mint buying sporadically cannot match. This creates a structural squeeze. Investment demand wants physical metal. Industrial demand needs physical metal. Primary supply isn't growing fast enough. Above-ground stocks drain, and mints get caught in the middle, unable to secure enough material to satisfy investment demand. What rationing means for markets. When the Royal Canadian Mint implements allocation, it reveals a fundamental market failure. In a functioning market, price rises until supply and demand equilibrate. If demand exceeds supply at $32 per ounce, price should rise to $35, $38, $40 until demand destruction occurs or new supply enters. But sovereign mints don't operate purely on market principles. They produce coins at fixed premiums over spot. When they can't source material at those fixed premiums, they ration rather than raise prices. This creates a two-tier market. Official mint products trade at official premiums plus scarcity premiums. A silver maple that the mint sells for spot plus $3 wholesale trades in the retail market for spot plus 12, because there aren't enough maples to meet demand at spot plus 3. Dealers capture some of that spread, but much flows to secondary market participants who secured inventory early. Anyone who bought maples at 28 per ounce in early 2024 can sell them for 44 plus in January 2026. Not because silver spot rose that much, but because premiums expanded from $3 to $12. This also creates opportunities for counterfeiting. High premiums incentivize fraud. Fake silver maples from China, often sophisticated enough to fool casual inspection, enter the market. Dealers report increased counterfeit detection, and some implement additional verification steps that add cost and delay. The combination of rationing, high premiums, and counterfeit risk fragments the market. Trust erodes. Small dealers struggle to source product. Large dealers with established mint relationships maintain access. The market bifurcates into insiders with access and outsiders scrambling for supply. The timeline of collapse. Let's establish the sequence of events clearly. Late 2023, early 2024. Premiums on sovereign silver coins begin rising from historical norms of 2 to 3 over spot to 4 to 6 over spot. Delivery times extend from 1 to 2 weeks to 3 to 4 weeks. Dealers report stronger demand but no supply concerns. Mid-2024, U.S. mint production strains to meet demand. American Silver Eagle sales pace toward highest annual total since 2015. Refiner delivery times extend to 6 to 8 weeks. Premiums rise to 6 to 8 over spot. Late 2024. Silver spot price rises from $23 in January to $30 by December. Investment demand surges. Refiner delivery times extend to 10-12 weeks. Some refiners stop accepting new orders. March 2025. Royal Canadian Mint implements allocation system. Dealers receive approximately 35% of requested volumes. This is the first major signal that the physical market is breaking. May 2025, U.S. Mint suspends American Silver Eagle production, citing supply chain disruptions. This removes approximately 42 million ounces of annual supply from the market. Summer 2025, Perth Mint extends delivery times to 16 weeks. Private mints report difficulty sourcing blanks. Premiums on retail products spike to $10, $12 over spot. Fall 2025, Canadian Mint allocations tighten further. Some dealers report receiving only 20-25% of requested volumes. U.S. Mint remains offline. Secondary market premiums reach $12, $15 over spot for scarce items. January 2026, the physical silver market operates under a rationing regime. Sovereign mints allocate production. Delivery times stretch to 10 to 16 weeks. Premiums remain elevated at $11, $13 over spot for standard products. The U.S. Mint has not resumed American Silver Eagle production. This isn't a temporary disruption. This is a structural breakdown that's persisted for 9 months and shows no signs of resolution. Who benefits and who loses? In any market breakdown, wealth transfers from those unprepared to those positioned correctly. Winners. Early buyers who purchased in 2023 to 2024 at lower premiums now hold assets trading at significantly higher premiums. Someone who bought 1,000 silver maples at 26 per ounce in early 2024 now holds metal worth approximately 44 per ounce in January 2026. That's a 69% gain, far exceeding spot. Silver's rise from $23 to $30, which is only 39%. Dealers with established mint relationships and allocation agreements maintain supply access. They capture margin on scarce product and maintain customer relationships, while smaller competitors struggle. Large industrial users with long-term supply contracts locked in pricing before the squeeze intensified. Solar manufacturers and electronics producers who contracted for 2025-2026 delivery at 2023-2024 prices avoided the premium spike. Losers. Late buyers entering the market in 2025-2026 paid $12-13 over spot for product that cost $3 over spot 2 years ago. They're buying at the top of the premium expansion. Small dealers without mint allocations struggle to source product. They pay higher wholesale prices, reducing margins, or go without inventory, losing customers to larger competitors. Investors who waited for better prices or lower premiums watched the window close. Premiums didn't compress, they expanded. The strategy of waiting cost them dearly. Anyone holding paper silver instruments like ETFs or futures contracts who wanted to convert to physical discovered that physical trades at massive premiums over paper prices. The basis between paper and physical, historically tight, blew out. What this reveals about the silver market. The 2025 breakdown exposed 3 critical truths about silver markets that many investors didn't understand. First, the physical market is separate from the paper market. When sovereign mints ration and premiums spike, it proves that paper prices don't reflect physical availability. Silver can trade at $30 on COMEX, while physical coins trade at $44 in retail markets. These are different markets with different dynamics. Second, sovereign mints cannot guarantee supply. For decades, investors assumed government mints would always produce coins on demand. The 2025 breakdown shattered that assumption. Mints are subject to supply constraints, procurement limitations, and production capacity, like any manufacturer. Third, supply deficits matter. The structural deficit between mine supply and total demand, estimated at 300 to 400 million ounces annually, drained above-ground stocks to the point where even sovereign mints couldn't source material reliably. These truths suggest that the physical silver market in January 2026 is fundamentally different from the market that existed in 2023. The assumption of unlimited availability at spot plus small premiums is dead. What comes next? Predicting exact outcomes is impossible, but we can examine scenarios based on historical patterns and current data. Scenario 1, supply response. New mine production comes online, recycling increases, or industrial demand destruction occurs. Supply and demand rebalance. Premiums compress back toward historical norms of $3.5 over spot. Sovereign mints resume normal production. This is the optimistic scenario. Problems with this scenario: mine development takes 5 to 10 years from discovery to production. There are no major new primary silver projects scheduled before 2028-2030. Byproduct silver depends on base metal prices, which remain weak. Recycling is unlikely to scale significantly at current prices. Industrial demand for solar and EVs continues growing, not shrinking. Timeline if this happens: 3 to 5 years minimum. Scenario 2, elevated premiums persist. The structural deficit continues. Sovereign mints operate under rationing. Premiums remain elevated at 10 non-hours 5 toners over spot indefinitely. The market adapts to a new normal where physical silver trades at large premiums over paper prices. This scenario assumes no major supply additions and continued strong investment in industrial demand. The market fragments further into paper trading at lower prices and physical trading at scarcity premiums. Timeline: this could persist for years until either supply increases substantially or price rises enough to destroy demand. Scenario 3, price spike. Investment demand accelerates further. More investors attempt to convert paper claims to physical. The shortage intensifies. Spot prices spike as the paper and physical markets attempt to reconcile. We see silver at $50, $60 or higher, driven by physical shortage rather than just investment demand. This scenario requires a catalyst. Perhaps U.S. Mint suspension extends into 2027, or major ETF holders demand physical delivery, or industrial users panic about supply security. Timeline: could happen quickly if a catalyst emerges, or slowly, over 2 out of 3 years as the deficit persists. Scenario 4, market fracture. The paper and physical markets fully separate. Paper silver trades at one price, physical at a premium of $20, $30 over paper. 2 distinct markets operate simultaneously. Those with physical refuse to sell at paper prices. Those holding paper cannot convert to physical except at massive premiums. This is the most extreme scenario, but not without precedent. During the 1980 silver spike, physical premiums expanded dramatically over paper prices. Timeline: we're already seeing early stages of this with $12 or $13 premiums. Full fracture could occur within 1 to 2 years if current trends continue. The historical parallel. There's one important historical comparison. 1979, 1980, the Hunt brothers accumulated approximately 200 million ounces of silver, roughly 1/3 of U.S. supply at the time. Silver spiked from $6 in January 1979 to $49.45 in January 1980. But here's the difference. The Hunt brothers were leveraged speculators. When COMEX changed rules to restrict long positions, they faced margin calls and liquidation. Silver crashed. The 2025-2026 situation is different. This isn't driven by speculators. It's driven by structural deficit. Industrial users need physical silver for production. Investors want physical metal as inflation hedge. And supply can't meet combined demand. There's no leveraged player to force liquidation. There's no rule change that solves the supply problem. The deficit is real and persistent. The 1980 spike was artificial, created by concentration of ownership. The current situation is fundamental, created by supply-demand imbalance. What this means, right now. As of January 2026, the physical silver market operates under rationing. Royal Canadian Mint allocations sit at approximately 20-25% of dealer requests. U.S. Mint American Silver Eagles remain unavailable. Perth Mint delivery times stretch to 16 weeks. Premiums for silver maples trade at $11.13 over spot. American Silver Eagles, when available on secondary markets, trade at $15.18 over spot. Generic rounds from private mints trade at $8.10 over spot. Dealers report that demand remains strong but constrained by availability. Buyers want silver but face limited inventory and extended delivery times. The market is not functioning normally. This is rationing, scarcity pricing, and allocation by relationships rather than price clearing mechanisms. What changed in 2025 was the revelation that physical silver markets have hard supply constraints that cannot be easily overcome. When sovereign mints with unlimited government backing and established supply chains cannot produce enough coins to meet demand, it proves the market is fundamentally supply constrained. This is the reality of the physical silver market in January 2026, not speculation about what might happen. Documentation of what already happened. The Royal Canadian Mint implemented rationing in March 2025. 10 months later, rationing continues. The physical market broke and it remains broken. Understanding why it broke, how it broke, and what that means for future supply availability is crucial for anyone trying to understand silver markets going forward. The assumptions that governed silver markets from 1988 to 2024, unlimited availability, tight premiums, reliable mint production, no longer apply. We're operating in a new paradigm where scarcity is real, rationing is ongoing, and physical availability cannot be taken for granted. That's not a prediction. That's the documented reality of January 2026.